As for earnings expectations, Morgan Stanley's bank analyst says strap in for a rocky ride. Joining us now, the analyst behind that report, Betsy Graseck. It's good to talk to you. We don't hear from you that often, Betsy. So what do you mean, rocky ride? What are these earnings going to look like?
Well, thanks, Sarah, and happy to be on the show. Appreciate it. I would say that the reason for that title, strap in for a rocky ride, has to do that there will be pushes and pulls in the earnings. On the positive side, we do have net interest income improving because of rate hikes. But on the other hand, we have pressure in fees, we have pressure in expenses, and we have pressure in credit quality. Not really aggressive at this stage, but we do see pressure in credit quality building, and we think that we'll start hearing about that a little bit this quarter.
So clearly the market's been worried about the turn in the credit cycle, Betsy. My question is how much of all of that bad news stuff is already in the valuations?
Right. So on the consumer finance side of the stocks that I cover, it's more priced in. You've got stocks trading in the consumer finance sleeve that we cover that's between 2.5 and 7 times earnings. Amex, of course, is higher at a 12 times earnings versus 2023. And so that sleeve is pricing in something closer to maybe a 6 to 8% unemployment rate, I would argue. But when you look at the regular way banks, the large cap banks, the mid cap banks that I cover, I would say that there's not much credit risk priced in there. Really, you're only about a multiple point turn below average. And if we get a tougher credit cycle, in particular in commercial, we will end up with more multiple pressure.
You say the top pick here is Wells Fargo?
Our top pick out of our coverage group is Wells Fargo. I would step back to highlight that in this kind of environment, we want to be long bank stocks that have excess capital, excess liquidity, and have positive operating leverage. Those three are critical for this environment. And that's Wells, MTB, Regions Financial. Those are the top three.
Even though they can't really grow that much with the asset cap still in place from the Fed.
Yeah, that's an interesting point. So I'd say a couple of things on that front. So Wells Fargo, to your point, cannot really grow its total assets, but you can still continue to mix shift from securities to loans, so you can improve your NIM and your asset yields through a mix shift. The second thing is, because they can't grow, they did not take on a lot of what I would call surge QE-related deposits. And as a result, they can behave like they have a lot of liquidity. They don't have to price up for deposits as much as peers that really need those deposits to fund their loan growth. In addition, with their excess capital, while they're not buying back shares right now, they could. There's many banks I cover that do not have sufficient capital to do buybacks right now today.